Hello, everyone, and welcome to BFW 2401. This is week 7, and we are talking about credit risk. Now, credit risk is in week 7 and week 8, and credit risk is one of the most important topics in banking. Actually, credit risk is the core of this financial intermediation function. Now, the way I divided this topics of credit risk, they will be divided into 2 weeks, which is week 7 and week 8. And when we talk about credit risk, actually, we are talking about framework. It's not only the defaulting, so we have the portfolio risk and we have the single loan risk. So single loan risk, we'll take it in week 7 and with its modeling and measurement and everything. And then in week 8, we'll talk about the portfolio risk and the rest of the modeling coming from week 7. So week 7 modeling is so many of them. So some of them will be in week 7 and some of them will be in week 8. Now, the different thing in this maybe credit risk issue is I usually have to introduce the framework. I have to talk about very interesting issue called credit scoring, but I don't want you to test you in that two part. So I make it in separate part, and you are not required to take it for just to have some knowledge, and it will help you actually follow what we are talking about because it brings some of the ideas. But you are not responsible about it in the test or in the final exam. Now, this week I have divided, for week 7, I have divided first the introductory slide, which is you are not responsible about, as I said. And the second is actually, we will talk about business loans, and we will talk about the measurement of business loans, old models and new models. Now, if you allow me to share, I will just start now with the introductory slides. And so this is what we are talking about, actually. Hopefully this will not take a long time, it should be short. So this is coming in week 10 and week 11. And when we talk about credit risk, we are talking about this area, which is the loan portfolio. Now, the loan portfolio is, we can deal with it from a single loan or from a portfolio. The most important thing, I think, this one is just the framework, and I won't tell you what is the framework. So when we talk about credit risk, we are talking about what we call transaction risk and portfolio risk. Now, let me talk about the transaction risk, which is the risk taken with each new single loan. Now, all of those loans later on will be a portfolio, and the management of the portfolio risk is a different issue, which is coming here. This is actually most of the modeling are dealing with this issue, which is week 7. So just to make it easy, when we go to any, and I always give this example, when we give a housing loan, we give it for 30 years, for example, or 25 years. And giving the loan is, choosing the right person to give the loan is very important. And therefore we should have some type of credit scoring, some type of checking of the person who is going to take the loan. Now we can talk about business loans, or we can talk about housing loan, or we talk about credit loans, whatever loans. So the first thing, we start with the selection risk. Now the selection risk, we have to have incorrect. The problem with this risk is you have just incorrect assessment of the credit risk. So like what happened during the subprime, you bring the subprime and then you choose them. When you screw up here in the credit, in the selection, everything later on is just accumulation and piling of the risk because the selection was wrong. It looks like when you get the wrong partner, or the wrong husband, or the wrong wife, or whatever. So in this case, whatever you do later on, you are not actually solving the problem, because when you take it in the first place, it wasn't fit. Now, the problem with also you can have incorrect assessment, but also you can have mistakes and fraud and mispresentation, like what happened during the financial crisis. They were, they were just making up documents and doing all these things, and this is actually coming in the selection. Now, assuming the selection is good and the person is good, is that enough? Actually, it's not enough, because you have to have a contract, and that contract should be good. If the selection is okay, and the underlying risk, underwriting risk, which we call it, the contract was not okay, then there is a problem. And the contract actually could be not adequately structured or managed or monitored. And when we come to the contract, for example, the terms and conditions we bought is not right, is not correct, that will end up in the courts and all these issues, or will let the customer to default. The pricing, maybe instead of putting a normal pricing, which means the interest rate you are charging, you go and you charge 20-25% for a business firm that is its rate of return is 15%. So you already know that you are charging 25% and this customer cannot pay. Then the sources of the payments, the sources of the repayments, and also the collateral. So all of those issues, when you are not sure of, and it's not written actually in the, or taken care when you do the contract, it will create another problem, even if the selection okay. Now, assuming the selection is okay, the contract is okay, the conditions are okay, but when you start living with this loan for the next 10 years, if it is a business loan, you don't maintain it. You don't go over it. You don't monitor. That will create something called operational risk. This is actually a potential failure for the failure of the system and the controls. And maybe the documentations are not okay. The admin monitoring is not okay. You have to have early detection of problems with the loan, so you can, grab whatever left from the assets before the company goes zero or the borrowers goes zero. So this is actually the operational risk. Now, when we go to the portfolio risk, it's either you go, maybe everything is fine here, but you go and you make intrinsic risk. For example, you invest in some type of businesses that actually have its own risk. For example, when you invest huge investments in oil. Now, this oil prices is going up and down all the time. And this, a replacement of what we call solar energy, air energy, especially when you make huge loans here. Same thing happened with IT. ITs have these old developments, and even when you invest now in automobiles, this industry is growing. So some of the industries actually have its intrinsic risk, and you have to be aware of those risks. And the other thing is, maybe there was no intrinsic risk. It was okay, but you concentrate. For example, there was some banks in Hong Kong, I think in the 90s, they defaulted because 80% of their assets was for 3 or 4 companies working in the housing loans, in the housing industry. And when the housing industry, there was a housing bubble, those customers defaulted, and of course the bank defaulted. So this is what we call concentration risk. There is no diversification in your assets. And this actually, it's good when the industry is good, but when it is bad, it will lead you to this problem. So this framework to give you some, background. Now, when we go, for example, in week 7, part 1, which I will come to it later on, we will talk about the selection risk, and we will develop some measures to say this company or this customer fit or not fit. So we already automate this selection risk through some data, and we have what we call IT solutions, and all these issues can help us and do the right credit scoring and select the right person for the credit card or the business loans or for the housing loans. Now, let me go to the I just take an example. I think my bank in this country have a good sophisticated system. I was looking for it today, but it's documented. I found this, I think 1 year ago on the Maybank. Public bank, as I told you, have a good system also. Most of the big banks, they have their own good systems. So for example, here in Maybank, when they talk about credit risk, they have 3 layers. The first layer is day-to-day, operations. So they have those systems and management to control the risk in daily basis within their daily activities. And then they have the second, they call it second line of defense. This is the people who make the policies, the framework of the credit risk systems. So they talk about the monitoring, the pricing. They have full system and documentation to control the credit risk. These people only applying these policies that is provided by the second layer and or the second defense, and these people actually try to do it. Update it and suggest systems that goes with controlling the risk. And the third one is you have to audit and you see whether actually the policies have been applied correctly. So you have to have this periodical audit. This is just, for example, something from the industry. When we talk here about operational risk, for example, operational risk, you can have also IT solutions. This is Equifax. Equifax is a company in the US, actually provide IT solutions. Now, these people, have developed something like an IT solution, and this IT solution, when this company actually involved with the regional bank, they actually checked around 900,000 loans. And you know what? In those 900,000 loans, they found they found the defaulting loans or fraud in those loans. This is only by the system before they give it to the management. They found a fraud of 14.6 million, which means around 2 million, around 1.2 million monthly. This is a fraud of loans. And actually that was, increasing. It reached 2 million monthly. How much they give to this, IT solution company, to Equifax? They give him, I think, 400,000. So IT solutions also, instead of the normal process, they can integrate with the system and they can also come up with this information to control this is something from the industry, for example. Now, let me move a little bit actually to the credit scoring. Credit scoring is a very important issue. And this is when we talk about the hard information. Now, when you go and take credit card, for example, you can fill those information all online, or you can find people around in shopping malls and gas stations, giving you some type of applications. You fill the application and they send you, maybe they will ask for your ID, and when they confirm, they can just take all your information and put it in the system. And if it is applied, they didn't even meet you sometimes. If you meet the criteria in the system, which is based on credit scoring, they will offer you. Otherwise, you will receive a letter saying, well, sorry, we cannot do that. Now, in these 2-3 slides, I'll tell you how does it work in its basic form. And let me tell you something about the judgmental and the what we call quantitative models. Credit scoring belongs to the quantitative models when we actually make it and deal with it quantitatively. Now, this is when we used to do it manually, according to the subjective way, which means qualitative way. So if you have 3 customers, this customer, which is Ishong, Ali, and Mattu. Now, those 3 people, actually, if you look at their information in terms of income, other income, car loans, age, other assets, you will find so many different issues, which is different, and which is different from each one. And you will find how much they, for example, this the housing loan application, this guy is asking for 140,000, this 240,000, this is 156,000, but this one the income is only 2,500. This income is around 10,000. Then this, have a private business, they make good money. Whatever the situation, you can calculate even how much each one makes approximately a month, and this and this from their pay slips. But you can find how many dependent, and this is if you collect this information, and how much they have other loans. So all in all, if you come now, for example, in our class, or if we take sample from the classes or from the credit officers, and you tell them which one we choose, I am sure some people will say I'll go with Matthew, somebody would say we'll go with Ali, some people will go with Ishan. This judgmental way of approving loans, it's no longer applicable. We cannot do it. So because it's it depends on how the credit officer or people who decide on the loan, they come up with the credit scoring. Now the credit scoring, for example, we take any one of those banks and say we take credit cards. Now I take, for example, public bank, and then maybe they have in KL area, maybe, I don't know, I'm just guessing a number, maybe 15 to 20,000 people who are holding credit cards. Now, I'm not sure, I'm just bringing some arbitrary, some random number. So if they have this, you will see how many people of those defaulted during the last 5 years. And then you will collect characteristics of their borrowers and see people. So the characteristics, for example, you will take income, education, you will take job, profession, everything. I will show you in the next slides. And then you will put some types of those characteristics, and then you will calculate some type of you compare it to good borrowers to bad borrowers, because you will do some type of numbering for the for example, the profession. If the profession is unskilled, it will have a number. If it is skilled, it will have a number, and then it will go like this. If it is private business, it will go a number, as I will show you. Then when you set that, you analyze the best borrowers using a point system. This is what we say, point system. And then when you see the people who default, when you take the people who default from the list, because you are taking the defaulting people, and then you see what the scores they achieved, and that will be the benchmark. So if somebody else come and say, I want a loan, and his scores like the people who actually have defaulted before, that means he's going to default. Probably he will default. Of course, then you will have your tolerance for how much you can take as a credit risk, maybe 1%, 2%. Maybe you play with that number and see how you can do what we call the benchmark. Now, when you do the benchmark, after that, whoever goes under the benchmark, you don't give him the loan. And whoever goes over the benchmark, you give him the loan. And this is all automatically. You just take the information according to this modeling you have done before. You key it in the system, and the system will give you red, yellow, or green, which means approve or decide about it or don't approve. Let me show you here how does it work. So look, for example, this is just an old one, okay? So if you take the, characteristics, for example, you will take the profession, you will take the housing status, you will take, maybe the number of the communications on phones or whatever. Then you will have how many dependents they have, how many accounts they have, what is this credit rating in the system, whether they have defaulted before, whether on the blacklist, whether they have been in the blacklist or left the blacklist, and how long he has been in the current job. Is he stable in the job or keep changing? And the length of time with his current address, is he just moving on all those addresses? And you can, this is just the characteristics you can choose according to this example, but you can add up based on the, I told you can take so many things, you regress them, and you see the mean of that. And you can do this statistically, and you can actually take the defaulting of these people and build what we call a probability of each of those ones. And you will see the people who default, which ones, and the people who didn't default is which one. So for example, a skilled worker will give them, if it is a professional or business executive, 10, for example, in this example, a skilled worker, 8, and you continue in all of those. You add those scores. If it is 28 or less, you reject the application. If it is 29 and 30, you can maybe extend to 500 ringgits or whatever. We take care about 500 ringgits, or we can, then you continue like this. If somebody is the best, scoring here the best, then in this case, you can extend to 8,000. Now they are giving 16,000 and 21,000. This is the credit scoring issue. Now this we use, this is for example for a credit card, individual business, but in the business individual borrower, and personal loans. But when we go to business loans, we use the balance sheet, and I will explain it in week one, in part 1 in week 7. This is the end of this part, and I will just stop here and say thank you, and I will see you in part 1. Thank you.